Are low interest rates impacting on your investment returns? It's time to rethink. Rethink Investing creates wealth for clients through the strategic purchase of positively geared, high cash flow commercial property. Industrial properties, retail assets, or office spaces can be a smart investment option that produces significant and long-term return on investment. Rethink your investment options and look to commercial property. Learn more at rethinkinvesting.com.au. Rethink Investing, Australia's #1 commercial buyers agency.
Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
G'day, how you going? Welcome to the show. Thanks for joining us. And today, back by popular demand, property update. And this is for our new listeners who have just found us. One of the backbones of smart property investment for nearing a decade has been us exploring our own portfolio, investing in property ourselves and sharing it warts and all. It's a very popular part of what we do, giving an inside view into a real life portfolio, what works, what doesn't work, where the challenges are, what we've done good, what we've done less than good, where some of my support is mediocre, which I'm reminded about quite regularly. But by and large, we've done a pretty good job. It's a good base portfolio that's performed well. Like all portfolios, it doesn't move in a linear line in growth. It's up and down and left and right. And we've had a pretty interesting market over the last sort of 2-3 years, which has been relatively lackluster. There's been some growth in there, but nothing considerable. Some properties probably gone backwards in value, just as a result of where they are and different market dynamics. But by and large, it's a good portfolio in that it is not a burden, in that we're able to hold it irrespective of the current situation. And now as we move into what's going to be a bull run in property, I feel, for the next sort of 3 years, we're in the market. We've got good exposure in different markets across Australia, across different assets, and we will do well. So property update is our way of exploring our journey through property investment. If you go into smartpropertyinvestment.com.au, you'll see years of posts around us buying properties, where we bought, why we bought it, what the numbers are around those properties, and then also narrative around the portfolio. And I bring in different people who are part of our property investment journey, the advisors that we lean on to help support us navigate this, our accountants, our brokers, conveyancers who we've used, other providers. And one of our key partners is our buyer's agent, our property strategist, who's been foundationally important to the growth of his portfolio, is Right Property Group. Steve Waters is joining me in the studio. We're going to do a bit of a stock take on where we are with our portfolio. We're going to start getting a lot more involved as we map how this portfolio is going to perform over this next period of time. So watch this space. Next month, we'll get together with we're going through a bit of review right now, so a full understanding of what those numbers are. I'm pretty clear on what they are, but I think it's growing by the day. So we'll check in next month and go through all that sort of stuff. But I thought this particular episode, this installment of Property Update, would just reconnect you in with the portfolio, give you a bit of an insight to how we've recalibrated it over the last period of time, some of the challenges we've had, some of the pitfalls, and some of the wins as well. Steve, how you going?
Good. How was your Christmas?
You're not bad. Feels like so long ago now. But
certainly, I don't know about you, but I thought Christmas was a non-existent event this year.
It just went. And I think a lot of that because of the outbreak. We're recording this in Sydney, really threw everything into a tailspin here in New South Wales, and there was a whole bunch of border closures. We seem to be doing all right now in terms of COVID and navigating, but I don't want this to be a COVID podcast. I want this to be a property update podcast. You're pretty familiar with this portfolio, Steve. You've seen it since its birth.
I'd hope so.
Yeah. Is it a good portfolio?
Look, I think it is. And the fruits of your labour are starting to happen or amplify now.
Absolutely. And this goes to the point about us being in the market where we are right now. Now, for those of you who aren't familiar with this portfolio, it costs us money to hold it from a pre-tax position. And those numbers, as it is right now, we'll share these a little bit more, but per property, it costs us about $3,000 a year to hold each property. Now, if we had one property, that's manageable, right? You times that by 18, you're looking circa $90,000 in negative cash flow a year to hold this portfolio. Now, some of those payments and some of that cost is around principal repayments. So some of it aren't on interest only. There's P&I stuff, and that's about $25,000 of it. And then also land tax is a significant part of the cost around this, is about $40,000. So you take those two things away, it's a pretty good performer.
Yeah, but to be fair and to be clear around that land tax component, it was almost like it's a necessity because of the entities into which they're held, because of the structure of the portfolio and business and what have you.
Yeah, and you could say, well, if it didn't have that, that's what it would be. If we weren't playing principle, that's what it would be. But guess what? It is what it is. So they're just what ifs and hypotheticals. So
it is what it is, but it's also a choice.
It's a choice.
Yeah.
It's a choice, and you need to be aware of that as a property investor. But so that's where we're at. So at the front end, costs us to hold this portfolio before tax. After tax, different situation. One of the values of being a property investor is that there is, good tax deductions you can get around it. And we've got a good accountant that helps us out with that. But 7.5 odd million as it was valued probably late last year. So we're going through a process now to work out what that will be. No doubt already it'll be north of that, I would like to think, over the last couple of months. But I don't want to get too much into that today. So 8 odd properties, Sydney, Brisbane, Melbourne, some regional stuff in there, like Central Coast and Shore Harbour, Wollongong area. Can I call that the Shore Harbour?
I wouldn't even call Central Coast regional.
Yeah.
Yeah, I'd just call that the Greater Basin.
The Greater Sydney Basin. Same with the Gong.
The Gong?
Would you say that's regional?
No,
well, it's
not at all.
metropolitan, but it's out. Would you say it's part of Sydney, sort of?
Well, I do, but it's in the eye of the beholder because for us, an hour outside of Sydney sort of boundaries isn't regional, but if you're in Victoria, an hour outside of Melbourne is.
It is, true. So you can go and have a look at the portfolio, smartpropertyinvestment.com.au. But yeah, the idea is just reconnect people in with it, give some sense for it. Now, Steve, I'm happy to report that for the first time in a long time, every single property in his portfolio has a tenant in it.
That's a great start.
That's a good thing, isn't it?
Well, it is. And maybe go back for the new listeners to go back to the prior episodes and to where we've talked about the trials and tribulations of certain tradesmen and a certain property and, potentially who and what the reasons are that some of the properties weren't rented. However, because of the way that the market is and was always going to happen, I'm talking really around tenancy now, in any of these areas, in fact, I'd probably go back for the last 3 years, in any of these areas, there was zero reason for anything to be tenantless.
Yeah.
But as investors, we all get caught up from moment to moment. And so we have to take responsibility.
Absolutely. And we're specifically talking about a property which was vacant for at least 9 months of the last 12 months, right? And it's going to sound really, really bad. And people are going to go, oh, Phil, don't you know about this sort of stuff? How do you even allow that to happen? And we spoke about it last time we were on this show. It's a property in Kingston, which is in the Logan Shire of Queensland, correct, Steve?
Correct, yep.
So that property now, and let's touch on it quickly. So that property is now tenanted. It's got some young guys in there who are guaranteed by their parents or their grandparents. I can't remember exactly the story, and they're paying the rent. So someone's in there, but we had to drop about 30 grand on fixing that place up, which was money I didn't really want to spend, but a lot of it was necessary money, wasn't it?
Well, it was necessary, but you could almost say that it was good money after bad because of the tradesman prior to that.
Correct.
Was very dodgy.
Yeah. So we got some work done there. It wasn't done properly, caused even more of a problem. So we had to spend more money on it. And this thing, that feels like it's been a bottomless pit, that property in Kingston. And I remember chatting with you a couple of times going, let's get rid of it. I just don't want to deal with it anymore. It's a headache. It's a nuisance. So I'm hoping it's going to go up in value now and get my money back, Steve.
Well, I'm pretty confident. In fact, my property literally around the corner has had an absolutely astonishing valuation on it, and I would say that it's very similar.
Oh, really? Well, let's have a chat about that. So this is a property in Kingston. It's a traditional Queensland type place with stuff built in the bottom, 3 bedrooms at the top, high set, is that what you call it? 3 bedrooms at the top, normal sort of house, and then someone had built in underneath it and not necessarily done a particularly good job on it. That's where a lot of the issues were. We had to replace a roof. There was water issues. There was some safety issues there as well I wasn't happy about, which we got rectified. It was pretty just badly done. There was carpet downstairs. There was a whole bunch of crap there. So it's cleaned up and pulled apart. So we bought this particular property in Kingston May 17. That's only 4 years ago, right? By private treaty. Now, we paid for it $290,000.
I think there was a reduction in there too.
Then. There was. All up, the total establishment cost. So that's like additional money we spent, sort of all the usual hullabaloo, kit and caboodle was 313 grand, like stamp duty, legals, so fully costed $313,000. Now, what do you reckon that's worth? We're going to do a full valuation at some point, but what do you reckon that's worth?
I'll use there was a comparable the other day I noticed one of the buyer's agents pulled up that sold in and around the corner from that, not as good a bones, I'd say, in terms of floor space or square metre floor space, and without the side access and rear yard that yours does, and it sold for $373.
Did it? Okay, that's pretty good. So we paid our all-in costs, and we'll have a chat about that.
Yeah, maybe we'll get a little bit granular.
Yeah, we'll get a bit granular on that. But what did you rate? What did it go for?
373.
373. Yeah, I've got it sort of in our spreadsheet here, sort of looking at numbers that we're based in our Val on like 320. So it's probably worth a few more bucks than that now, right? So anyway, so we'll go through and do all that properly. But let's just refamiliarise people with how we view our investments. We're going to go to a break beforehand. Back in a moment.
Are you struggling to invest in property this year and need help buying? Then you need to book in a consultation with Investor's Dream and let us do the hard work for you. Don't fall victim to missing out on incredible deals like everyone else. Lock in a meeting today. Go to investorsdream.com.au and secure your financial freedom today.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show. Property update time, looking at the Smart Property Investment portfolio with our property strategist, Steve Waters. Now, we'll chat about this Kingston property in Queensland, and some of the challenges we had with it, a whole bunch of work we had to do to remedy it so we can get tenants in there. There's been an out. We even ended up in a position where we had to pay some rent back, I think, by memory, because someone wasn't happy about some carpet smelling because of water damage. And it's been a saga, this thing. It's been an absolute saga. And this is why we do the property update, is to talk about these things. But let's talk about metrics for a moment. The first point, Steve, and we're going through a process now of doing the valuations on the portfolio, but how often should you, recalibrate the value of your portfolio? So I haven't done this for probably a year or so. And it doesn't matter because I'm not trying to refinance it, but how often should you be doing it?
Yeah, look, clearly it's a very different asset from, say, shares where it's measured by the second.
And you can realise that value immediately
correct,
as well. If someone wants to buy shares at a particular price.
Correct.
Yeah.
For me, I like to do it every 6 months.
Okay.
Now, there are movements that we'll see, up, down, sideways, left and right. But I don't pin my hat on that because unless I'm releasing equity, it's a feel-good moment. Or if I'm making my equity liquid. But we do want to see the trajectory up. As you mentioned earlier on, it's never linear. You'll make some, give some, and then it'll go sideways. But as long as the general trajectory is up, that's what we're after.
Yeah, and that's what we're after. That's what we're trying to do. It's a good portfolio. And to the point we made earlier, we're moving into a really interesting market. So we've got a good portfolio in a market with exposure in markets which are slated for significant capital growth. So we don't have to do anything at the moment, do we?
No, you're in a position now where all the hard work has been done, and that's the creation and the control of the portfolio, so that now all the heavy lifting, which is always time, we can enjoy potentially a bit of a bull run in the market to increase that equity position or its total value. But the other important aspect of this is the way that the property was created was to take advantage of certain areas, certain opportunities, but also keeping cash flow at the forefront for the most, so that we played within our own thresholds in terms of what we were willing the portfolio to cost without having to live on 2-minute noodles.
Yeah, and to the point around this Kingston property, sort of 9 odd months without it tenanted, that was a hassle, right? And we weren't generating income off it. But you must see it with investors, wouldn't you just get a fixed fill? It's costing you.
We did have that conversation.
I know, but it was just the prioritization of it. It was, I think it's renting at $350. There you go. So it's $350 a week we weren't making for that period of time. It's tens.
It's a lot of money.
A lot of money.
Yeah.
It's a lot of money.
But this is where it comes down to choice. So you had the choice to do it or to ignore it.
Yeah.
And that's an individual decision. And I think most investors with a sizable portfolio has eventually a moment in time where the allocation of capital needs to be thought of in terms of priority.
Yeah.
And if this at that moment in time wasn't a priority, well, then the direct cause and effect of that is a higher cost to operate.
Yeah,
and to
higher
keep.
cost to operate. And that's the hassle. But, in hindsight, I wouldn't do that again. You've got to get on top of stuff pretty quickly. Just with this one, it just felt painful. And part of it was, I think, not a very constructive relationship with the property manager of this property. And there's a bit of a finger-pointing scenario going on. Well, they won't name him, but...
no, there's a lot of finger-pointing and there's a long email chain, and we discussed that, I think, in one of the prior podcasts.
We did.
But this is also, as investors, as landlords, we can be guilty of perhaps relinquishing responsibility to the property manager because we pay them. They work for us, essentially. Yeah. But the job of of a landlord as an investor is to manage your managers. It's an organisation and you need to be on top of it. But we're all guilty of not doing so.
We are, and it's a really good point here. I can sit around and whinge as much as possible. I don't really whinge that much. I'd like to think I put my hands up against it's mostly my fault, but there is no such thing as bad teams. There's only bad leaders. Now, in a business sense, right? So if you put that in the context of your portfolio, guess who the leader is?
Correct.
It's you.
Guess who it affects?
It's you.
Correct.
So if your portfolio isn't doing what it needs to be doing, or there's challenges or problems within it, it's not hard to work out what the problem is. It's yourself. So your team, most people I know who operate in property have a team, and the team might be property buyer, might be your accountant, might be your conveyancer, might be your mortgage broker, might be your buyer's agent, might be your property strategist, might be your financial planner.
Might be your property manager.
Might be your property manager. If things aren't going right, there is no such thing as a bad team. There's only bad leaders. So you've got to look within and work out what's going on. And this year, overall, our portfolio is cool. Yes, things can be done a bit better, but that's right. But this particular scenario on this property in Kingston, the reason why it was such a bad scenario and it cost us money was my individual leadership of that. I could have done more. So I can't blame anyone around it. I've got to put my hands up.
Ultimately, you can't.
I can't.
Is that going to fix the situation? It's still your money out of your pocket.
I wish that property manager's not doing their job well enough, or they got that wrong. Well, that's my fault. So anyway, so don't go looking for blaming people. Blame yourself. And
no, but also it's a really good example of property is not a set and forget asset, contrary to what a lot of people say it is.
Yeah.
It is something that is, in my belief, needs constant input, constant management. Now, that doesn't necessarily mean time or too much time. It does require time. But when you've got several $1 million at stake, doesn't it deserve that time?
You'd think so, wouldn't you?
Yeah, I'm not pointing the finger at you. Yeah, I am. But for all of us, because it is a very, very big asset. So we need to give it the respect so that it actually does perform the way that we want to, or we can extrapolate every piece of value out of it, whether that be cash flow or expenditure reducing.
Yeah, and this is the Smart Property Investment Portfolio. So this is the portfolio which we've built within the narrative and the story and the platform of smartpropertyinvestment.com.au. There's the portfolio is owned by different properties in different trusts, and those trusts are owned by myself and also my business partner, Alex Whitlock, right? So this is a portfolio we build together so we can tell the story within Smart Property Investment. We also have portfolios out, so we have other assets which sit outside of this portfolio in property, and also other asset classes like business and technology and stocks and all this sort of stuff, right? But this is our way to tell the stories and give a real inside view on how, as a property investor, you can go about doing this. Now, the key point to take away from it is that Phil Tarrant is an idiot and he ran a bad team, and therefore he's responsible and accountable for a bad outcome with this particular property in Kingston. The flip side of that is I've now resolved it. So
you identified it and you resolved it.
Identified it and resolved it, and I've taken ownership for it.
But the other component to all of this is you've managed everything else well. So all the other properties,
they're okay.
They've done their maintenance and repairs have been kept in check. You've been involved as where you can be and possibly. And so we don't have those types of cash flow loss because of reasons that we could control.
Yeah. There's one really bad performer in the portfolio. There's one or two other things which are a bit of a headache and could be better, but by and large, it's sort of okay. So that's where we're at with it all. But it's hurt, that cash. I'd rather that cash be in my bank account, helping to minimise the negative cash flow position on this portfolio. But,
But as we move forward, we can also identify other areas to tighten up income and expenditure.
Yeah, and that's a discussion we'll have over the coming months, right? So we'll go through the process of, I guess, repricing the portfolio to actually know where we sit right now. And we've got to remember also, that's not real. It's not real money. You only make money out of property when you realise the value of that asset. And there's essentially two ways you can do that. Number one is you can sell it and pay a fee in order to realise that money. So all the buying transactions, you got to pay a real estate agent to sell it. You're going to have to, depending on your situation, you have to pony up a considerable amount of capital gains tax to the tax man. Everyone's going to get a drink out of that on the way, and you're going to end up with a bit of money that you can use to do something else with, number one. The other way you can realise increase in value in your portfolio is through refinancing and realising it in another way. It has costs associated with it.
I think there's one other aspect that you can realise the growth, and the equity position is a lever for whatever else it needs to be. So it's total value minus total debt depending on what your flavour is and what other business assets you have or whatever you want to do, the bank is going to look at that at your net position.
Yeah.
So it's a tool, albeit that at that point in time it's not physical.
It's not physical.
Correct.
Yeah. And therein, like, property is not a liquid asset in many ways.
It can be.
It can be if you structure your finances correctly. And one of those things is like an offset, right? You can get that
offset,
money
redraw, whatever it
all
may
that
be.
sort of stuff. Unlike shares where you can get in and out of it in a millisecond if you want.
And do you know what? It's a really good thing that you can't get out of property that quickly, because could you imagine the markets, historically speaking, over the last 10 years, if you could get out of property within half an hour? It'd be the biggest roller coaster ride, both for the positive and negative in terms of growth and lack of growth that you'd see. But the fact is you can't and it won't.
And therein goes the shares versus property discussion. And my philosophy towards a diversified portfolio is key. You need to try and spread not too wide, but into some really smart assets. Now, a couple of ways you can look at the value of a portfolio, Steve, and just give some sense so you're familiarised with this for when we have a deeper discussion around valuations, etc. next month. A couple of ways we measure this portfolio. And for those of you who have requested beforehand, I've provided our spreadsheet, a sort of template of it for you to use with a couple of examples. You've got to fill in the gaps. It's pretty cool. Steve used it in a spreadsheet. It's not a bad tool if you're not able to or got capable to make your own.
It's a great spreadsheet. There's every bit of information that you could possibly want and more.
Yeah, and that's therein a bit of a challenge as well. But if you want the spreadsheet, happy to share it with you. Editor at smartpropertyinvestment.com.au is who you need to email. Now, we look at it in two different ways, from a valuation point of view and a cash point of view or yield point of view. So there's capital growth and then there's performance. So really 101 property stuff. Why do you invest in property? There's normally two levers or two outcomes, and you want to try and get both of them as possible, but both isn't necessarily always achievable. So you get one or the other. One is you buy a property and it goes up in value, or the other one is that you buy a property and it generates you positive cash flow. So the cost to hold the property is less than the money you receive in the income from it. And then that's positive cash flow. That's money you can do the other things. So that's highly connected in with yield. So the yield being the return on your investment. Now, we measure yield, Steve, and this is a perpetual debate. No doubt you have it with a whole bunch of different people. We measure yield in a number of different ways to give us some understanding of the performance of a particular property. Now, we measure yield on a net rental yield is one way, which is against the establishment cost. So what you pay for it and what were all the other costs on that property we're talking about in Kingston, we paid like $290 for it. But with all the other stuff like
stamps,
there's LMI, or it's not capitalised LMI, the stamp duty, legal costs, all the other stuff is like $313,000, right? So we base one of our yields as in income. So income being how much do you get for it a week, $350 times it by 52 gives you a number viewed as a percentage of the value of it. So that's one way, net rental yield. We also we call it book rental yield. And this is a traditional way how most people measure yield, as in the purchase price without all the other costs. Another way that we measure it is market yield based on the current valuation. There's often a very different number to what you would get on your book rental yield or net rental yield, because that takes into consideration capital growth from purchase, debt yield. So the yield against the size of the mortgage is another way we look at it. Then we also look at monthly repayments versus rent and a gross profit ratio on repayment. So a whole bunch of different ways that we measure it. Is that too many?
Look, for me, it's not. That's exactly how I do it, because I can sit down for dinner or for lunch with a whole heap of other industry people, and we've all got different opinions. So rather than have the argument, I just say, well, I got them all.
Yeah.
This is how I look at it from each aspect. And the reason I do that is because if you take the debt versus yield, or the debt yield versus income, that's a fact based on the right here, right now. And so I like to know that. So if my net yield is 4% and the cost of money is 3%, I'm on my way to a good spread.
Yeah.
But it starts to water down once I look at its value today versus net yield, because hopefully that actually in a weird way you want it to get skinnier, because that means your asset value is growing.
It's growing.
Correct. Yeah. But then the argument happens, well, I could get a better yield out of ETFs or whatever it may be, but you don't get the leverage and you don't have this and you don't have that. So whatever floats your boat, I like to have them all.
Yeah, so let's give a bit of an example in this, and obviously we'll go back and reaffirm these numbers. So property, and I'll use this one because it's the first one on the spreadsheet, so it's easy to work it out, but also You sent me a note just the other day, I think, when you were out in the western suburbs of Sydney lurking around looking at property, an asset that we secured way back in October 11, so nearly a decade ago, in North St Mary's, which I think is going to end up being a pretty good purchase considering that's where there's a new train station just opening up.
But even
down
if you segment that away for a minute, it was a great purchase for all the right reasons, and it was only a year later that it was worth 100,000 more.
Yeah.
So as a percentage terms and growth, it was pretty good. But the reason I was out there is because the rest of the team were really, really busy, and it's a great way for me to reconnect with the market and keep my finger on the pulse.
Which you need to do. You've got to get your hands dirty, Stephen. It's not
Correct.
all Pinot and Wagyu steak these days, is it? When was the last time you picked up a hammer, though, and banged down a wall and did a bit of a reno on an investment property?
On an investment property?
Yeah.
It's been a few years.
Yeah.
It's
Probably when we did that Luxford Road, that Mount Druitt reno.
Yeah, and the listeners should go back and watch that video because if the block's got nothing on us. That was a full renovation to make a unit brand new in a weekend.
Yeah.
Down
There's
to
no
the
drama.
lights.
There's no drama. It was just a bunch of people getting stuff done. We'll do that again.
That was good fun.
I was only in a storage shed the other day and I looked at literally I've got enough tiles to tile the 16 chapel, right? But anyway, so North St Mary's. Now I've got the number here and the discussion is about yield, right? But as an example, but 2 bedrooms, corner block, traditional weatherboard type, 1950s-ish type house, as you would imagine, any given street in Australia, right? What do you reckon she's worth these days based on the current market?
Well, so let's strip data out of it and let's talk fact.
Yeah.
So
what would it sell for?
What would it sell for? Between 650 and 700 today, every day of the week.
650 to 700.
Yeah, it's quite a unique block. Remember, it's a duplex block. If necessary, if we didn't want to do that, we could put a secondary and come on it.
Yeah.
Today, yesteryear.
100 grand, chuck a granny flat on it, which we've spoken about.
Yeah, well, say it's 150,000, you'd get $300 a week rent. What's that? About 11% yield on your money. Not a bad return. But the reason that I know it is because that day I was at the other end of your street where I went to an open home and there must have been 100 people through there and it needed $20,000 worth of work immediately. It was pretty ordinary, the renovation that was there. Low side of the street, sloping backwards. There was nothing attractive from my point of view for it. Main road as well. And it sold for $680. Two better. Badly done.
Okay. So this
on
one,
the day too.
Yeah.
Actually,
that's great.
like an hour after the open home.
Like contract, bam, done.
Yes. It was, that's just.
How much? 650?
680.
680. So we've got a corner block in a nice street, park opposite, duplex site. That's a pretty good asset. That's probably for the smart property investment portfolio. The next thing we'll probably chuck up a duplex on that. We might do
maybe,
that. Yeah.
maybe not.
Yeah.
But it's not only is it a corner block, duplex site opposite the park, well located. The setbacks on that particular property are very important as well. So, and what I mean by that is, it's all great to have investors seem to chase corner blocks, but if there's too much of a setback from the curb, it actually starts to diminish
where you're allowed to build.
Correct. It diminishes the envelope to which you can do anything and often makes it irrelevant. You just bought a corner block thinking you can do something and it's just not workable.
Do your homework. But anyway, so we're using this as an example. So back in August 11, we paid Steve. What do you reckon we paid for that? Remember?
200 and I'm going to say 220.
215. Right, which
wasn't too far off. That's not bad for 10 years.
215,000. And in my sort of spreadsheet I've got the current valuation at 580. That's way off.
I'll give you 600 tomorrow.
Would you?
I would.
Yeah. What about today? So what?
580.
So an open market, you reckon that's going to get at least 620, 630?
I think it'll get 650.
650. All right. So
as walk out the door.
All right. So I've got that at 580. Now let's go back to yield. The current, so against this property at a valuation of $580,000, on that basis, growth since purchase is still 169% in 10 years, right? On that.
It's not bad.
It's pretty good. Yeah, it's pretty good. I told you it was the right property to buy. Anyway.
Yeah, you did, yeah.
And we spent, to be fair, $18,000 on a reno one. It took us 5 weeks to do that. And it's all on smartpropertyinvestment.com. You go and check it out. But the net rental yield on the establishment costs, so establishment cost being the purchase price, it being also the additional spend at purchase, which is stamp duty, and we even factored in the reno on that. It was $249,000. So the yield on the establishment cost, 7.1%. The book rental yield, so on the actual purchase price, 8.2%. So this is currently rented out at $340 a week.
And I'd say that's a little bit skinny as well.
Yeah, I think we're going to get that reviewed when the lease comes up for renewal. Market yield on the current valuation, at 580, 3%. You go, well, that's not very good.
It's worse if it's worth $650.
Yeah, the debt yield, 5%. So we refinance this at least once, maybe twice.
It's done its
along
job.
the
You've
way.
recycled your initial capital out and then some to then put in, to redeploy elsewhere.
Yeah, so monthly repayments versus rent. So 72% of the rent goes to servicing the debt. That leaves.
Is that at 3.56?
No, it's a 4 point something or other.
So, because this is the first property off the.
I lie. That one is 3.56. I worked the bank recently and they gave me a new rate on it.
Yeah.
Yeah.
That's okay, that rate.
That's all right. Yeah, I can't get any more from them. I got to call them up again and give them a bit of a hard time. But I locked stuff in with that same lender at 4.29 thinking I was getting a good deal. You must have some of them.
I do.
Yeah. But we're just numbers we're talking about, the yield. Like, does the yield actually, is it a useless conversation? Like, why do we need to talk about yield on this property? Does it matter? It's just really as a benchmarker, and I'll quickly go through the portfolio, I won't give the actual properties, but net rental yield against establishment cost, we've got 7.1%, 6.4%, 8.6, 6.6, 7.7, 8.9, 4.5, 6.9, 5.1, et cetera, et cetera. It allows us to benchmark, right? But other than that, so what?
Yeah, look, we can paint it up with some tricky numbers.
Yeah. So what?
And look at it. But at the end of the day, what's in, what's out, and what's it done?
Yeah. Yeah.
And I think that's the question. And maybe in the following episode, when we get granular, we can look at what that initial seed fund was, and how far it's gone.
Yeah, and I think it's important. So we're talking at a income level, but at an expense level, looking at the numbers we have here right now. And again, we've got to go through a process of recalibrating some of this because the market has changed, but expense-wise, largely hasn't changed, right? Expenses don't really change that much unless you're actively doing stuff. You got mortgages, land tax, council rates, water,
Property management.
They're the big five, right?
Yep.
They're
the constant.
They're the constant. You can't really change them too much. You've got some repairs and maintenance, and we factor in a little bit with it. And what we've shown, and we've spoken about this on doing a property update before, in terms of levers on reducing cost, you don't have a lot to do. You can't get it. You can't squeeze it. You can't continue to squeeze. You can't cut some costs. They're just there, right? So your operating expense profile is probably going to stay the same, and you can't really change the income position without doing something quite drastic. Renovation,
for the most,
adding a granny flat, etc.
Yeah, for the most. And the unit that we did is a great example of making a difference.
Something quite drastic.
Yeah. However, there are moments in time where you'll see the organic rental growth. Yeah. Therefore income. But you need to be quick to take a hold of it. And that's where these reviews are so important, because if we talk about, the North St. Mary's house, I'm going to say that we're somewhere between $20 to $30 a week behind. Now that's $1,500 a year or thereabouts.
It's a lot more than that. It's $159 a week.
No, I'm talking about the rent.
Oh, the rent, sorry.
The rent,
okay.
Yeah. And then, if I look at the next one.
Sorry, how much did you say?
Say $20 to $30 a week.
Okay, so I'm looking at the net position weekly after expenses on that particular property, $159. So that would save us $30 on $159. $30. If you up the rent by $30, it would change our negative cash flow on that property considerably.
Absolutely, but
on a weekly basis.
But if you kept your finger on the pulse of all income from all properties, then suddenly that's a sizable difference to the bottom line.
Yeah.
So whether you're an investor with one property or 101, income is clearly an important aspect, but so too is the expenditure, and probably more so. And in fact, most people want to concentrate more on the income than they do on the expenditure, whereas I think with expenditure you can actually there's a bigger net effect to you.
Yeah. Well, expenditure is important because that gives you your negative or positive position on cash flow.
Correct.
And so that's how you hold a property.
It's the negotiation of rates. It's keeping repairs and maintenance down. It's a combination of all matters.
All the usual stuff. But
correct. To
that point, no. So on this property here, which is North St. Mary's, $159 a week it's costing us to hold that property after expenses.
$159 a week. That's with the increased debt position because you've taken all your money out a couple of times. So if we equated that to one property only forever and ever, those numbers theoretically would change, but it's not. It's been a lever.
But so put that into context though. So that property, are you going to get 10% in North St. Mary this year?
Are we going to get 10% in North St. Mary's this year? Is that a calendar year? I'm going to say yes.
Okay, just for easy numbers, right? So on that basis, the valuation I've got on this property, which is probably not right, it's probably on the low side at $580,000. If we get 10% on that, that's $58,000 in capital growth, right? Property's costing me $159 a week to hold. So in really simple numbers, that's $1,000 a month in capital, $1,000 a week in capital growth, and it's costing me $159 before tax to manufacture that. Is that a good way to look at it? You get caught up with it, right? Because a lot of people do. The people talk to me all the time. That's the way they frame it. So I wanted to use that as an example. So I'm getting $1,000 a week growth in value of it, and it's cost me $150 a week to do that.
Look, I think if you wanted to put that filter on it to make yourself feel better, absolutely, because property doesn't have that instant
hasn't been doing that in the
gratification
last couple of years,
scenario. That's correct.
It's a moment in time.
Yeah, but if we annualise that compound growth from the day that you purchased it through to what it's worth today, you could potentially look at it then with some more accuracy.
Which I do when I get my accountant in Munzrul Khan from Cash Hub, and he actually gives me those numbers. And
then cash on cash return.
Cash on cash return. Yeah. And he goes, Phil, your cash on cash return is a bazillion % because all the cash you ever put in this portfolio you've taken back out.
And this
so it doesn't owe you anything.
This is the point.
Yeah.
It doesn't owe you anything other than its week-to-week costs, which could be, I'm going to guess, somewhere in the vicinity of 20 to 25% better than what it is today.
Yeah, I agree with you. It cost me like $1,700 a week to hold the portfolio.
Yeah, I think you could smash that down.
Yeah. Which I've been doing. It used to be a lot worse. You remember we've been speaking about it. So,
it was just before Christmas. We'd be speaking at 7 o'clock at night where I'm so happy I've got off the phone to X bank and I've renegotiated after 4 hours.
Yeah, you got to put the time in. But I actually found out that a lot of the mortgages I had, which I thought were variable, were actually fixed rate. I still haven't worked out how that happened. But anyway, watch this space. All right, we'll get another break. When we go back, there's some other little things I want to touch on back in a moment.
Whether you're an avid property investor or about to buy your first property, why do it alone when you could partner with Australia's best buyer's agent? Director of Pure Property Investment, Property Investment Professionals of Australia board member and REB Buyer's Agent of the Year, Paul Glossop, can take your portfolio to the next level. Get in touch today to discuss your investment goals. Get one-on-one insight from Paul Glossop. And for the first 100 people, this service is completely free. Head to purepropertyinvestment.com today to schedule your consult with Paul Glossop directly.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show and Steering Property Update, our discussion around the Smart Property Investment portfolio with Steve Waters. He's director at Right Property Group, property strategist that support us acquiring this portfolio over, what is a decade?
10 years.
10 years. Has it been a good experience for you, Steve, working with me? Or is it sort of like some bits good, some bits less than good? Am I just like inverted commas, like an average punter? You've got lots of people that you work with like me doing this sort of stuff. How average is this portfolio is the question.
How average is this portfolio? I think from...
Management is pretty average, but...
Oh, management's horrendous. But from inception, back at that point in time, we could establish a portfolio of this volume back then. That wouldn't be feasible today in such a short period of time because of the way that finance is quite different.
Interesting.
And around rules and regulations, serviceability and what have you. Are you typical? There is no two clients the same. And I know that sounds like a bit of a cliche, but it's...
You love everyone the same, do you?
Yeah. But it's the truth. So everybody has different objectives. Everybody has different capacities and thresholds. And this was just unique in the fact that from day one it was in Smart Property Investment magazine and warts and all.
Yeah, and it has been warts and all. And managing, and I miss it, and we've got to get back into it. As I was saying before, I've got all these tiles ready to go and some kitchens and stuff. I want to get back doing some renovations. I do enjoy it.
Do you really?
Oh, yeah. Yeah, I really enjoy it. You know what I'm like. It's just good.
Yeah, you're a great delegator.
Yeah. I do most of the work myself.
No, he does. To be fair, there's pictures of him laying, 300 square metres of turf one day out at I think it was Cambridge Park.
Oh, that's right.
Many years ago in a time lapse.
Mate, there's tiling, there's demolition, there's painting, there's...
Yeah.
Yeah, it's all... And that goes to the point, right? Most of the sweat equity you can do yourself if you're up for
Unskilled
stuff.
Yeah.
Some of it, like tiling, requires a bit of skill, but I think most people should be able to tile. It's not that hard. It's all about preparation. But
look at you talk it up.
I know.
You're doing well. But to be fair, you practice what you preach, and this was very much a normal portfolio with a normal filter on it. In other words, sweat equity. So you were digging holes and ripping out kitchens and, with everybody else around you, mates, like it was like, you'll put on the barbecue and a beer and you had all your mates around to help you.
Yeah.
And that's quite atypical of how we all start.
Yeah, and you just start, and we probably got quite a big advantage manufacturing equity like that. But you look at this portfolio now, Stephen, let's talk Sydney because this is where we're recording and quite a few assets here in Sydney. It's not worth, like in broad strokes, not really worth investing in renovation of any of the properties we have, is there? It's just you wouldn't get too much value out of it. Like, because people are sitting there thinking, and the point is a lot of people are sitting there thinking, I've always got to be doing something to my portfolio. Got to be doing something. And like you talk about numbers, you can always be working on rates and minimising expenses or being more efficient. That's one thing. But in terms of the manufacturing of equity, it's not always relevant because a lot of people get carried away. They go to these renovation seminars and they go, I'm going to be a renovator. I'm going to renovate my house. And you go, well, it's not going to change. You might get a few more bucks in terms of valuation and maybe $10 a week in rent. Like, why do it? So is it worth us doing anything to our Sydney-based properties? Say I've got a bit of a tinkering for some renovation work.
I'm going to say no. I'm going to say no, but it depends on what would we be trying to achieve. If we're trying to achieve cash flow by doing a renovation to increase its rent, then we would want to look at the return on investment. We spend $15,000 on a renovation. What's the percentage yield return in terms of increased cash flow? But is it also going to give us an equity lift? So because these were established quite some time ago, they're doing their job. I would be more inclined to maybe point out some preventative maintenance and take advantage of what I believe is going to be an undersupplied market in terms of accommodation by adding accommodation. If we were concerned about the cash flow and we wanted to increase its cash flow, well, then let's put on some secondary incomes.
Yeah.
That's probably where I would be. But if we're not concerned about that, then deploy capital elsewhere.
So on that basis, then, are you better off investing time, energy and effort into secondary some sort of additional income or manufacturing for renovation, or you're better off going acquisition in this market right now? Like, do we need to be acquiring in this market? Or
I don't think you need to be acquiring other than your portfolio is in a position which allows you to be tactically opportunistic and where we would be looking for something that we can make a difference to accentuate the equity position rather than rely upon organic growth. That like every property has a purpose for being there and it always should moving forward with everybody.
Yeah, I agree. All right, so let's check back in next month, mate. We'll break down in the interim. And you've got to spend some time recalibrating and making sure we've got fair market value for all these properties, and it is fair market value. And we'll base that based on bank val or sale val?
There's two types of valuations. There's bank val, which can be quite different from what a contract val is. So if someone was purchasing that property. So I would rather put valuations on what we know is reliable. In other words, 1 Smith Street sold for X and it's comparable to this.
Okay, then 2 Smith Street is therefore this. And
correct.
And we're not valuing this portfolio for the purpose of refinancing. We're doing it to get a sense for its value in this current market.
Correct.
So we'll do it based on contract value. So yeah, I enjoy doing that. Hopefully, I wonder how much wealthier I feel as a result of it. What do you reckon? I'm going to feel
We'll give the answer. Depends on whether you buy lunch or not.
Am I going to feel 5% wealthier? But talk about that. So in order to do that, we'll be digging through all the different real estate platforms to do our own comps, and we can also do sort of AVM type stuff also, right? Like
in a market that we have today that's quite buoyant, data reliability is quite small.
Yeah.
Because the data can't keep up.
But don't unnecessarily overplay. A lot of people go, I'm going to look at how valuable my portfolio is. It's worth $1 bazillion, and mate, like it doesn't benefit anyone, right?
No,
like
you just want to be truthful. It's not going to help.
Yeah, say as it is. But all right, I look forward to doing that, Steve. We'll find a time to do that, and we'll be back in a month's time to go through all that. If you've got any questions at all around this portfolio, get in touch. editor@smartpropertyinvestment.com.au is where you need to go. Anything to that email address relating to this will end up in my inbox from my team, so please do that. Also, if you want a copy, we've got it. It's there ready to go of this spreadsheet. I know we said it beforehand, took us a little while to get it to people, but we've got it ready to go. We can send it to you. Also, editor@smartpropertyinvestment.com.au. Go there, request it, and you can just pretty much plug in your numbers, and it's got all the formulas and stuff there, and it'll do everything for you. Steve, thanks for your time today. I do enjoy it.
Yeah, good to be back.
Good to be back, and that's portfolio update for this year. We'll chat again soon. Until then, thanks for joining us. I'll speak to you soon. Bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.